Joining me in studio, of course, Mark Todd from Fixed Securities and Tim Hampton from BIS Shrapnel. Gentlemen, I wanted to talk a little bit about the government's role, fiscal, I suppose, strategy, policy that we have at the moment of the fiscal help, if you like, that was announced by the government in that budget, particularly middle to lower income earners. I mean, do you see that filtering through to the economy, or are people just going to be paying down their debt?
I actually see this year being a pretty good year for household spending. We've already seen the year begin with reasonable momentum with the household sector, mainly spending overseas, but there has been quite a bit of growth domestically. You've now had the lower interest rates, which at the margin will be stimulating spending, and then you're getting this big wad of cash going into people who they've basically taken money from people who weren't going to spend it and given it to people who will spend it. And so I'd be expecting to see some pretty strong retail numbers through the third quarter. What won't be strong though is the building side of the economy, with residential building and non-residential building. That sort of investment is going to require sustained lift in confidence, and at the moment that's not there, and don't see that happening for the next few months.
Bring it back to the panel in studio with me, Mark Todd from Fixed Securities and Tim Hampton from BIS Shrapnel. Tim, the state of the economy. We heard the Treasurer, we're talking about maybe a little bit below trend growth at the moment, but that's expected to get back above to trend. And John just mentioning there that, look, maybe the state of the economy doesn't warrant serious cuts at the moment.
I think in terms of serious cuts from here, I completely agree. We're looking for growth probably around about 2 3/4 to 3% over the next year or so. So I wouldn't be saying that's getting up to above trend. It's sort of holding around that trend or sub-trend level. And where the weakness is in those interest rate sensitive parts of the economy. So that, again, that domestic building, whether it be residential.
Does this then help? I mean, does 25 basis points help? It's not, the statement, the big sort of 50 basis point cut that a lot of the market looks for, because that cash rate isn't exactly anymore the impact sort of to boosting confidence it once was.
That's absolutely true. But business decisions like that aren't made in 1 month. You've got to look at it in the context of the interest rate cuts that have been not just last month, but those that were done 8 or 9 months ago. If you're sitting down 12 months ago, there was a project that was off the table. Now you've got a project that's back on the table going, well, actually I'm paying 1% less interest on that. You look at that sort of planning is done on an annual basis. It's not done on a monthly basis. So, yeah, there is real stimulus that has been added to the economy. Yes, it's been needed, but for parts of the economy, it's really going to help them.
And at the moment, at least in terms of the current data, which is a bit backward looking, but also forecast, inflation not anywhere near being a problem.
As I said at the beginning, Reserve Bank's in a really sweet spot at the moment. Inflation smack in the middle of the target range. They've got flexibility to provide some big insurance cuts if they are needed down the track. I don't see those as being required yet, but they've got the capacity to do it and don't risk inflation going out the top. At the same time, they don't need to worry about deflation or pushing the economy into recession if they're too slow in lowering those rates.
Mark,